I'll just start. So the last time, oh the last time we talked about um price cycle and then things like strong guns and weak guns. So we'll just today we're just gonna talk about accumulation and distribution and the just the phases in it and how it actually like how you can recognize it on the chart. So it's basically we're going to be talking about the structures, like structural aspects of Wyckoff, right? So a book that can really help you with accumulation and distribution is this book. I talked about it last time, Anatomy of a Trading Range by Jim Fort. So he actually, I don't know if I've pronounced his last name correctly. Anyways, he explains like the law of cause and effect and all those stuff, but it actually goes deeper into accumulation and distribution and schematics and the things you would see in accumulation, like the phases, the events, and yeah, all those things there. So this is a chart by from stock chart, actually by Roman, and he actually visualizes the accumulation and what it looks like. Obviously, it doesn't happen exactly like this on the when you go on the real time on your charts on like TradingView or MT5 or whichever one you use. So, what the idea of accumulation is when price is at um you know um is at a level where there is value. What institutions do is they accumulate, and the whole purpose of accumulating that position is to absorb all the supply and the position, so they can push prices and increase prices, and then they can distribute and get off the position. So you might have a question like, okay, why would they like want to accumulate in the first place? So the thing is that so for example, when we talk about stocks, so when they say stock, that kind of like long term, there is some value to it, and the stock is kind of like underpriced or oversold, they might start to accumulate at that level. And what they basically do while accumulating is they buy all the shares they can. They try to buy shares large enough to move prices in the market. So they do that while people like other participants in the market like weekends are still selling and all that stuff. So there are different phases, right? So I'm just gonna stop presenting so I can use my pen. So they'll define value and then they buy at that value zone. So they start buying from here, and then they accumulate. So basically, they accumulate their position in that trading range. So what they do in accumulation causes a trading range, because as price keeps declining, yeah. So they buy into the decline where they start find when where they've seen value. So the reason why they won't just like load of all their positions in the market is because when they do that, you will see spikes like this in the market, and it's that's kind of catastrophic to the nature of the market. So they won't do that. So they would accumulate in bits and keep buying throughout the trading range until they feel like all the supply until they seen that all the supply has been absorbed, and there's gonna be one final test to the downside to check for any available supply in the market, like as in the case of a spring. And if that fails, like based on the concept of a spring, if you visualize a spring in the nature of it, if you apply force, if you apply a force to a spring and press it down, what happens? It springs back up. So they're gonna apply some. That's the reason why you might see a bit of increase in supply when there is a spring or shakeout movement. So they're gonna apply some sort of force, like sell at that point, and market is gonna go down to test for more supply. If there is still like some interest, like supply at those zones, the market goes into and it tests on high volume or high supply signature, then we might continue down and the whole buyers might change to distribution. But in the case of accumulation, it tests down on low supply because after that shakeout, there's most people, I mean, most traders who are like, trying to sell in this position after the first attempt to go down reverses, the second attempt to go down reverses, and then the third one that reverses over, they're gonna like, give up their position, and there's not gonna be any supply in the market, and then you're gonna see like just low volume signature as price advance for the trading range. So basically, that's how the accumulation materializes in the market. So there are different phases in accumulation and distribution. We have the phase A, the phase A, we have the phase B, we have the phase C, phase D, and E. So each of these phases, right? Each of these phases, there are things that are peculiar to them. So with phase A, some of the things you would be looking for is your preliminary support. And what does preliminary support basically means? It means that it's the first attempt to stop price from declining in a bear market. So in a bear market, the first attempt, so you're gonna see increase in supply on the preliminary support. So that is the first attempt to stop price from moving downside, and then there's gonna be a second attempt, which is gonna be our selling climax. So that second attempt, it would be on high volume as well, but might not be as high as the volume we had at the preliminary support. And then the capitulation that happens, the climatic action that happens to selling climbers will cause a rally to the upside, and that's when we have our automatic rally. And then we're gonna test that area of selling climbers, and that gives us our phase A. So that is the characteristics of phase A in accumulation. And then there's gonna be phase B where we're just gonna keep testing the area of selling climax on low volume. So sometimes they think with phase B there might be some spikes in volume as a result of the test, just telling us what price is gonna do in the range, and that's gonna be discussed, when we start talking about volume signature and all those things. And then we're gonna go into phase C where we have the final test, and then we're gonna have our last point of supply when price is ready to move up. So the last point of supply is just there are levels where institutions are buying on the way up, and then there's gonna be a backup in action. And the reason why we have a backup in action is usually when price breaks out of a trading range, there is a tendency to reverse back into the trading range. So we want to test if the reversal is going to be an up thrust, if there's going to be supply, because if there is a lot of interest at this zone, price might come here close below and then just tank down and spend more time in the trading range, or just tank down and go into distribution. So that's why when in backup in action, you don't want to enter on the first test on the backup. You want to see a bit of like commitment to the upside after the test, more commitment to the upside before you get in and backup in action. So it has to be, your backup in action has to be from a level of sign of strength. If you're having an up thrust, then the backup in action might be, might be a question like, is this an actual backup in action or an up thrust after distribution? But in the context of accumulation, so that's what happens. There is a final, accumulation at this level, at the backup in action before we then move to the upside. So basically, that's accumulation, and you would see the Roman kind of called this. He called this schematic one. So there are different schematics with accumulation. It happens in different shape or form. But the thing is that the events that happens will always stay the same. They'll always be your selling climax, automatic rally, secondary test, and final test. So the only thing is you won't have a spring all the time. So sometimes prices decline and just test, goes into phase and then goes to the upside, as we would see in like the second schematic. Let me just put that on. As you can see in this schematic, so we had a test in phase B, and then because there was no reason for price to come to the level of support here, because if you check if these had volume signature, I'm very sure it's probably going to be something like at this test there was not really there wasn't really any like I'm coming any meaningful supply, like any massive supply. So there was no reason for price to come to that level to test the supply. And then we have last point supply, accumulate more position, back up in action, and then up we go from there, markup. So there are also other schematics that sideways, you know, to the upside. So in those kind of schematics as well is different from the rectangular kind of schematics where you have your support and resistance in the kind of a rectangle. So in this form we have like up sloping accumulation, and then we have the down sloping accumulation. So we up sloping and down sloping, there are different volume signatures to them that helps you recognize if it's actual accumulation going on, or if it's a distribution, or if it's a reaccumulation or redistribution. And those are things we will discuss, and when we talk about these things in depth, when we start having like classes and all those stuff, we'll start going deeper into the analysis and you know the interesting things like that. So let's just go into distribution and or Juga, do you have anything you want to like add to that, or like any question or anything about that?
Let me think one sec. Nah, not really. I don't have any. I don't have any questions. That's so far.
Yeah. So if we go into distribution, so what happens in distribution? So when institutions accumulate, so they need to sell, right? So what they do is as price advances, right? So let me just bring this up again. Oh. So as price advances to the upside, just like I explained last time, let me just go on that. Anyways, let me go. I'll just explain with this. As price advances to the upside, there's going to be an area of inactivity where strong guns are not really buying anymore. They're just waiting to to see where price is gonna go and where they're gonna start taking profit. But weekends, they're gonna see value at the the very bullish candle, and then when the news has been sold to them, they're gonna start buying towards the end of the trading range, and that's when the volume signature is gonna increase and supply is gonna start coming in, and that's when strong guns they're gonna start distributing the position they've accumulated, and they're gonna start distributing it, and then weakens are gonna keep buying, and strongers are gonna sell into that, keep selling into the strength of weakens, and then when they've distributed like all the positions they're holding and that from the previous accumulation, there's not going to be enough force to keep the market on the current price. Let's say this is $100. Let's say price is $100 and hovering around $100 to $80. There's not going to be enough force to keep price at $100. And what's going to happen if there is not enough force to keep price on that level? It's going to tank, and it's going to tank hard, and it's going to cause capitulation to the downside. And then institutions are going to find value at the previous area of buying, and then they're going to start buying into that and accumulate or distribute depending on the value of the stock or the outlook on the situation of the market. So that's what happens basically in distribution. So is more of like taking profits and creating the environment to get off like your profitable position if you were buying if you were buying up to the stages of distribution. Because if they decide to sell at these buying climates, like sell all their position, it's going to reverse into all the profit they've made, and it's just going to be like a um catastrophic event, because it's going to reverse all the profit they've made. It's not going to make any sense that all the profit they've made on this level and all that stuff, just because they're selling real quick, because there is no liquidity. They need liquidity to avoid volatility when they sell. The only reason why they would do that kind of like maybe sell at once and just liquidate all their position is if there was already liquidity at these zones. So they wouldn't be scared that if they sell at this zone, there's gonna price is gonna tank and take all that profit, because there's enough liquidity in the market to absorb all the selling. But if there is not enough liquidity in the market, they're gonna want to create that by making others fake out, pushing price up and then selling into it and all those stuff. So that's what happens in distribution. Let me just go over the phases and events real quick. So we have the preliminary supply. So just like preliminary support. So what happens there is the first signature you see from institutions that attempt to sell into the strength, and then you're gonna see that spike in volume, and that spike in volume that was rejected is gonna cause another rally that goes into buying climax, and then our buying climax is gonna be followed by automatic reaction. And why is that? Because there's gonna be lots of supply at this top. So the supply coming in at the resistance created by buying climax is going to cause a reaction to the downside, and then that reaction is going to get absorbed at the previous area of buying, which is going to cause a rally to the upside, and it's going to give us a secondary test. But the quality of that rally is going to show some weakness. So if it's in the case of distribution, this is not always the case. This is just like a textbook stuff. So in the case of distribution, the automatic rally is going to be weak, and it's going to struggle to like you know, overcome 50% of their buying climbers swing. And if it's going to be a reaccumulation, we're going to have a very strong secondary test, because there's going to be lots of value here to buy more. And then we're going to have a secondary test. And one of the things that is notable about distribution is the sign of weakness in phase B. So there needs to be a sign of weakness. You need to see a level of commitment on high volume, on increasing volume to the downside, just for you to, just to confirm that we're in a distribution. So we want to see a level of commitment to the downside for a long time, not like a spring action. And then we're gonna have that on increasing volume. And that's gonna also get absorbed at the area of let me put this up so it makes it easy. The supply coming in is gonna get absorbed at the area of value as well, which is gonna cause a rally to the upside, but it's gonna tank like quickly into the trading range, cause we're now in distribution, and the value seen here is gonna be weakened, because they're gonna be looking at pullbacks. Yeah, they're gonna be looking at pullbacks, and they're gonna buy here, and then they're gonna make some profit to the upside. But then what happens? The institution is gonna like sell into that liquidity again, which is gonna cause an uptrust, and then they're gonna just keep doing that and trading range until we get to phase C, where there's gonna be a second, a second excitement that is gonna create massive liquidity in the market for them to offload all the shares they've bought. This is the second thing. The thing that's gonna happen in the phase C is gonna cause a change of character as well. So there's gonna be our first change of character in phase A, and there's gonna be our second change of character in phase C to the downside. So this is gonna be our second change of character, and this is gonna be our first change of character. This move to the downside. So let me just so our first change of character is gonna be this, and then our second change of character is gonna be this. So we're gonna have a change of character to sign of weakness. It's a sign of weakness, and then we're gonna have another change of character to say a major sign of weakness in phase D, which is gonna confirm to us that we're in phase D of reaccumulation. I don't know what's wrong with my voice today. It's just very like, I don't know. Maybe it's the weather and stuff. So we're
Yeah,
gonna
right. It's cold outside.
yeah, and the weather is kind of a bad weather. It's very cold outside, raining. So we're gonna have a change of character in phase D to the downside, and that's gonna lead to a major sign of weakness. And now we're gonna want to be looking for trades around that zone and trades at that. So we're gonna have last point of supply as market declines, as market goes out of the trading range, which is where institutions are adding to their position, and that defines what happens in phase D, right? So that's how it goes with distribution. Is just like a mirror version of accumulation. So, but there are some things when it comes to the volume signature of distribution and accumulation. So you want to see like increase in supply on sign of weakness, an increase in supply around the area of UTAD, and then as market declines, there's going to be decrease in supply and demand because it's going to go down with ease of movement because there's really nobody buying or selling except adding to position and all that. There's no massive selling and buying happening. So just like I said with accumulation, there are different structures to distribution. So there is the textbook one, the first one we have. Not most distribution or not all distribution will give you the UTAD, but the ones that give will usually give you a nice opportunity to get in. So you don't want to be waiting for UTAD in all your distributional structures, except if the volume signature and the quality of the rally that are happening suggests to you that we're gonna come back to the area of upfrost. Because in some distribution, just like we have in like example 2, we're gonna have rallies into upfrost, and that's gonna be our best rally, and then the subsequent rallies are gonna just stop at last month supply. They're not gonna be able to commit above the trading range. And when that happens and causes a change of character to the downside, we're gonna want to enter here at this last point of supply to the downside. So those are the two major schematics for distribution. I mean, obviously there are other schematics. There is the upsloping as well, upsloping distribution and downsloping. So usually with the downsloping distribution, you would rarely have up first after distribution because it's already making lower lows. Like there's already weakness in the market. There's no reason for price to go upside before it tanks down. So and then there are obviously other kind of schematics like the hypodermic ones, and the TP formation and all those stuff. But we're obviously gonna discuss about those things as well. And when we start, um, teaching all this in depth, like well, the proper courses and all that stuff. And that's what we're going to talk about. All the characteristics, the volume signature with hypodermic and TP formation distribution, and the volume signature with the up sloping and down sloping, and all those stuff. But for now, what you need to like know and can actually set you up for trading, because you can just look for structures in the market for now. As a beginner, if you don't know how to trade Wyckoff, or like you're new to this thing, you just go into the market, look for your like buying climbers, your secondary test, and then your sign of weakness in the case of distribution, or more tests in the case of accumulation, and last one of supply to the upside, or a spring to the downside before we go upside. So those are the things you want to look for. You want to make sure that your phase A is confirmed, your phase B is confirmed. What would confirm phase A for you in the case of distribution? Increase in volume, buying climbers, automatic rally, secondary test, your preliminary support. That's going to confirm your phase A. Your phase B is going to be on low volume inactivity, and in declines to the downside, you're going to expect increase in volume on those declines, which is going to define your sign of weakness. And then on phase D, you're going to see a weak rally to the upside that is going to get rejected by this selling zone created by the upthrust in phase B. If it gets rejected at that selling zone and causes a change of character to the downside, that's going to define your phase D. That means we're not going to have phase C. And then we're not going to initiate a position when price comes back to last month's supply before we go down. Or you want to wait for increase in, volume signature, I mean, if the quality of rally, after this upthrust, if the quality of rally, if the spread, for example, of the bars are strong, so you want to see some kind of like commitment to the upside, some move to the upside that is quickly rejected by back into the trading range, causing a second change of character, which is going to define phase C for us. So you want to see that for phase C, and then when you see that, you want to see like some last month supply to initiate your selling position. So you want to see that come to the level of interest, so where buying has occurred before. Because what happens with last month supply or last month support in the case of accumulation is it comes to the area of previous support or resistance. So in the case of last month supply, it would come to the area of previous support, I mean resistance, and that is gonna act as a support. And if you reject that and causes a change of behavior to the downside, you're gonna want to enter that as your entry for the distribution. So I know this is kind of rushed because I can't wait to go into the market overview and all that stuff. But all the things I've explained, anyways, should kind of guide you, and then um, set you up for thinking about accumulation and distribution, and set you up for Wyckoff and how to trade the events and phases. Jiga, do you have any like question or any contribution to you know to
Yeah, so like you were saying, like let's say for phase C, for accumulation or distribution, like either supply demand has to be like absorbed, and then price should move like with exhausted supply and demand,
yeah.
like either movement. It could be for sign of weakness or sign of strength, right?
Yeah, yeah,
Yeah.
yeah. So the thing about volume signature I was talking about is in reference to the volume we had at the start of the trading range. So from preliminary supply, the volume up to buying climax is going to be our reference volume to see if there's been an increase or decrease in volume. So when there's going to be some like spikes in volume around that UTAD, offers after distribution, and then there's going to be LPSY. So the volume around there, it might increase because there's selling going on. The supply that was at the start of this trading range is not going to come to those levels, and that's what we call ease of movement, like the relative volume to our starting volume. Do you understand what I mean? So it's going to be ease of, because when anytime we have a volume that spikes above that, that's going to suggest to us like a trading range is going to happen for a redistribution or a reversal to the upside.